So you are somebody who is a CPA for athletes, right?
Yes.
I want to jump into that because I think a lot of the parents who listen to this, I think when they think about CPAs, they think about people that maybe are a little older, maybe their local CPA who handles, the local businesses and maybe some doctors and lawyers and whatnot. But a CPA for a professional athlete is vastly different. What's required of you for them looks a lot different than if you were just doing a tax return, let's just say for a local business. Let's get into that a little bit. Because you played pro ball, and the reason why I wanted to bring that up is very specifically kind of how these guys get paid,
Yes.
what they go through, how they, you don't really make much money early. When you have an opportunity finally to make some money, whether it's out of the draft or in pro ball, the window of making that money is very small. So one of the things that I've always instructed players is like, it's not that the local guy is bad.
No,
right?
No, and I stress that a lot.
Yeah, it's just that he's not as well versed in how athletes make money. So there are going to be things that we jump in on this podcast, like duty days and things that you have to kind of calculate and be aware of that a normal CPA, it's not that they don't understand or know. They may just miss it. They may not be aware of how guys are paid. So their advice or the things that they're doing for you just may look a little different. So let's start, I guess, with the first thing that would probably, I imagine, be on the parent's mind, which is the signing bonus. So as you're working with the family, going through the draft, what are the things that you would be instructing or talking to them about as it relates to the signing bonus?
Things have changed now with what can happen within baseball because of NIL. So there are some top picks that are getting money at 16 years old from sponsorships and stuff like that. At least when I was around, that didn't exist. So it was your first shot of making money off of playing a game. And as your mentality when you're growing up, it's wow, I'm going to make money playing a game that I've played since I'm 5 years old. This is great.
I would do it for free and they're going to pay me. Well, it's amazing.
Yeah, it's incredible. But then all of a sudden you have this tax chunk come out and you don't know what it's for, where it's going, why. And of course, if you have an agent, you have agent fees and stuff like that. So you think, hey, I'm getting a signing bonus for $500,000, $1 million.
Yeah, I'm getting $500,000 or $1 million in my bank.
Yeah, you think you're getting that when at the end of the day, once everything's run, 60% of that.
Right.
So getting back to your question, as far as navigating the draft, we want to set up things before the draft where we can put the player in the most advantageous tax situation. So what that really means is you're always going to pay federal taxes on what you earn. There's no way around that. There's no way of, you can see things online of people saying, well, you do this, you do that, set up an LLC. Can't do that. Team is paying you directly to perform your services.
So let me just touch on this because if you're a player listening to this, I want to make sure that you understand. When you get paid for your signing bonus, right? There's two components. One is the federal tax. One is the state tax.
One is the state tax. If you are in a state, if you're a domiciled or a resident of a state that has state taxes, obviously Texas, Florida,
Tennessee.
Washington State, Tennessee guys, they have nothing to worry about. I remember actually when I first signed and we were all in the clubhouse comparing our signing bonus checks. And one of my buddies, he lived in Texas and I was a New York resident. And I was like, it's like, damn, dude, yeah, he signed for more money than me. I was like, damn, you kept a lot more than I did. But, he was a Texas resident. So getting back to the point is, if there are things that can be done where we can establish either domicile is the easiest part of establishing where you are as far as where you're going to get taxed, or residency in another state. There's two different things here, and we'll get into that later. But if there are things that can be done to make that process happen now, before they receive the money, there's reasonable cause to say, hey, this person doesn't live in California anymore. They're a resident of this state. We want to withhold taxes in this state and pay the state taxes there, or pay no state taxes there.
Right. So let's, I guess, get a little bit more specific for the listener. So prior to the draft,
yes,
you essentially, and we've done this obviously together, but you essentially say, okay, who are the teams that potentially have interest in drafting you? All right, it's these, let's just say it's these 10
Correct.
teams. Okay. What's the amount of the signing bonus that you would reasonably expect that you would make? Okay, let's say for argument's sake, it's $1 million, right? Okay, so $1 million, what you essentially do is say, let's look at what that would look like if you're a California resident and you're receiving $1 million from the LA Dodgers, right? This is roughly what it would look like from a tax perspective. We'll also show you what it would look like if it was the Cleveland Guardians, the Miami Marlins, etc. So the family gets to see, okay, I can totally understand then if this is where I'm a resident, this is where I'm domiciled, to use your term. This is how much I'd be looking at if I was drafted by this club. This is how much I'd be looking at if I was drafted by this club. Now, another component to the signing bonus is obviously, well, how is the money being split up? Most teams, if you're signing for a number like $1 million, you're going to split that payment up in 2 separate payments.
Correct. And that's a great thing that they do. And they've been doing that for as far back as, I've been practicing, and that's what they did with me. They split it up over 2 tax years.